Hi, and welcome to Frank Talk on Mortgages. I'm Don Scott. I'm the CEO of Frank Mortgage. Today's topic is fixed versus variable rate mortgages. Variable rate mortgages are the talk of the town these days with interest rates increasing so much, as most of you know. And we're going to have some videos on variable rate mortgages coming out soon. But first, we thought we'd do some definitional introductory stuff on fixed versus variable rate mortgages. So when we talk about mortgages here, though, we're going to talk about 5-year mortgages primarily because that's the most popular term for mortgages in Canada. So what is a fixed rate mortgage? Well, it's a mortgage where at the initiation of the mortgage, the interest rate is set at a rate and it's kept at that rate for the life of the mortgage. And your mortgage payment is the same every month for the life of the mortgage. So it gives you certainty, gives you ability to budget, knowing what your mortgage payment is every month, and it gives you the peace of mind knowing that you don't have any exposure to changes in interest rates, which is a real positive. Then there are variable rate mortgages where the interest rate on your mortgage will change when short-term interest rates in the market change. So if short-term interest rates go up, the rate on your mortgage goes up, and likewise it goes down when short-term rates go down. There are two types of variable rate mortgages though. There's adjustable rate mortgages where you get instant feedback on that dynamic because your payment goes up when rates go up or it goes down when rates go down almost immediately. And then there are variable rate mortgages that have static payments where the payment stays the same. If rates move around a little bit, your payment doesn't change. But as we're seeing recently, what can happen is you can hit a trigger rate or a trigger point, which we'll talk about in a separate video. But rates can go up so much that they eat up the entire mortgage payment. Mortgage payments being comprised of interest and principal. As interest rates go up and the interest component goes up, the principal amount goes down because the payment doesn't change, but then the interest rate can go beyond that initial mortgage payment. And at that point, then your bank's going to get in touch with you and ask you to, pay more. So that can be a complication. But variable rate mortgages are good for you because they're lower rate mortgages than fixed rate mortgages, as long as you have the risk tolerance to absorb interest rate risk and the financial wherewithal to pay higher debt service costs if rates go up. That's not something that most of us like, but it's okay for some. So when is a fixed rate mortgage really right though? Well, for most of us, we like certainty. We like to be able to budget and plan, knowing that our mortgage payment is going to stay the same. That's a real positive of fixed rate mortgages. Also, just knowing that we're not exposed to interest rate risk. We have low risk tolerances and we don't want to put interest rate risk into our homes. And the third thing is not really so much financial as it is just sort of personal, is the peace of mind, knowing that as there's noise out there in the market and headlines flashing that there's interest rates moving here or there, you can sleep at night knowing you're not exposed to it. You've got a fixed payment for the term of your mortgage and you don't have to worry about what's happening day to day in the marketplace. Variable rate mortgages may be suitable for you though if you think you might need to break the mortgage before the term expires. Fixed rate mortgages, one of the big downsides is that their prepayment penalties are much higher than variable rate mortgages. You break a variable rate mortgage before its maturity date, you're going to pay a 3-month interest penalty, which isn't great, but it's smaller than the interest rate differential calculation that you usually find ends up being the penalty calculation for a fixed rate mortgage. And that difference can be thousands of dollars. So if you think you're going to break your mortgage before the term expires, a variable rate mortgage might be right for you. Or there are circumstances where you can only qualify for a variable rate because one of the benefits of variable rate mortgages is the rates that are struck at the time you get the mortgage are usually lower than the fixed rates. So add on the stress test 2% and you may not qualify at the fixed rate plus 2%, but you may qualify at the variable rate plus 2%. But if you do that, just be very, very cautious that you now have taken on interest rate risk and you need to be able to handle it if interest rates go up, especially if you have an adjustable rate mortgage where your payment's going to change right away. You need to know that you can afford that in your monthly budget. So just be cautious. And another circumstance where a variable rate mortgage might be right for you is where you believe in your ability to predict where interest rates are going. I personally don't think anybody can do it accurately, but you may feel differently and that's totally fine. That's a personal preference. But again, just make sure that you have the financial wherewithal to be wrong on that prediction. And if rates go up, that you can afford the incremental payments if it happens. So there are pluses and minuses to each kind of mortgage. But what is the market typically seen in Canada? Well, if you look at the historical data here, you can see that 30% or less of mortgage production in Canada is tended to be variable rate mortgages. That kind of makes sense to me. We're pretty conservative in Canada. Certainty of a fixed rate mortgage, even though we may pay a higher interest rate than a variable rate mortgage at the time, just view that as the cost of insurance of protecting yourself against interest rate volatility, that rates may go up and cost you more in the future. So we tended to favor fixed rate mortgages. 70% or more of mortgage production has been fixed rate mortgages. But that changed recently. Roll the graph forward, and you can see starting in early 2021, variable rate mortgage production increased. We're going to talk about that, why that happened, and what the consequences of that are in our next video. But for now, that's a brief introduction on fixed and variable rate mortgages. I'm Don Scott, CEO of Frank Mortgage. If you'd like to get in touch with us, talk about your mortgage needs, this is how you can reach us online or give us a call at this number. And thank you very much for watching.